For our COBT listeners and viewers, it's Maynard, Mike, and Jeff here with something which is just what the doctor ordered. In this case, I'm talking about Dr. Kruti Lehenbauer. Kruti is a good friend that we've gotten to know through many of her social media postings and other publications and posts. She is sometimes referred to as the data whisperer, but in our estimation, we've really enjoyed her reports, her analytics, her use of data, statistics. She's a master's and a Ph.D. In economics and public policy. And so she really dives into the issues, and we're 1 week out from the Fed, but there's always lots of other things we can talk about. We've teed up some great topics. Kruti, let me just say thank you. We're delighted to have you join us and really appreciate your time today.
Thank you for the kind words, and I'm very excited to be here. Because it's all about understanding what goes on around us.
Well, we can't wait. That's kind of what I'd like to think that's what Veriton's about, Mike. What do you think?
Oh, definitely is that is exactly right.
Understanding the world around us.
We're all about it.
Can we borrow that, Kruti? We're going to say that now.
Go for it.
At least in energy, but energy applies to so many things. We get to meet nice, smart people like yourself. All right, Mike, I see, I will share. Mike has red and green font in the spirit of the holidays as he on his cheat sheet.
Yeah, Maynard. As far as, what we'll talk about today is, Dow's up a couple 100 points today. And it really is because Bitcoin is rallying today. As most of you know, over the last month or so, Bitcoin's gone from 125,000 down to around 80,000 this past week. And now it's up around 87,000. So a bit of a rebound, but that's kind of been weighing on equity markets over the last couple of days. Bond yields keep inching higher. Crude oil price continues to be under pressure. Natural gas, we'll have some interesting things to talk about there. It's a star. And basically copper continues going higher, it's hitting all-time highs. Not a lot of talk on that recently, but we thought we'd get that in. As far as the basically bond market, the 10-year yield, we talked about it last week on the COBT. It got to below 4% because Kevin Hassett was rumored to be the next chairman of the Federal Reserve. And he might be, I don't know, but Trump has said that he'll come out early next year and name who that is going to be. Bottom line is, we've said it for a while, December 10th is the big day. That's the FOMC meeting. Everyone's looking at that to see what the Fed's going to do. And I would assume you're going to have a lot of narrative coming out of that, as well as a lot of narrative coming out of President Trump, depending on what they do there. So that's the big day. As far as broader equity markets, like we just said, I think the markets have been volatile. Bitcoin has been the main mover of the markets as of recent. But as we think about it, nothing has really changed. I mean, energy continues to lag because oil prices are going down, and the leader is big tech, right? And big tech continues to lead the market, hasn't changed at all, and so that continues. As far as energy commodities, WTI continues to be under pressure. I sound like a broken record there. We're trading at just under $59 a barrel. The biggest culprit, again, is people's expectation for what the oil surplus is going to be in first half of 2026. You've got estimates, down in 1.5 million barrel surplus to as high as 4 million barrel surplus. So the key word is surplus. There's going to be a surplus that's going to keep a lid on crude oil prices. And so, what I would say to that is that it is very, very, very consensus that oil is going to be under pressure. That doesn't mean it won't be. It's just very, very consensus. And so anytime we see something very consensus, I tend to want to go the other way. I don't think it's too early to start getting bullish, but we're going to have to get through this period of pain. I think the interesting thing to me is OPEC met last weekend, and they did what most people expected. They basically put a pause on oil output hikes through Q1 of next year. But they also did something very interesting. They came out and basically said they want to have third-party verification of OPEC members' maximum sustainable capacity as a reference for the 2027 baseline production estimates. And so essentially what OPEC is saying by doing this, and frankly, this is really Saudi directed, if I had to guess, is they want to see what verifiable maximum sustainable capacity estimates are. Not capacity that OPEC says they have, not capacity that oil markets think they have, but really what is verifiably estimates of of what their reserves are and what they will be. And so I think there's many implications, both positive and negative, to that. As far as U.S. natural gas, we're up almost at $5 an MMBTU here this week. The 12-month strip is around $4.15. It hasn't moved much. And the reason why gas is up at $5, the prompt price, is because cold weather is upon us. Gas storage is still a little bit above average. And so that's interesting. I think what's really interesting, and I was talking to Jeff about this earlier, and I hadn't noticed it being away in Panama for a week, but natural gas production, lower 48 natural gas production has really spiked. At the beginning of this month, it was around 107, 108 BCF. It spiked to as high as 114 BCF. Now we're back down to 112 BCF. That's a 4 or 5 BCF spike in the course of 1 month. I don't know where all this is coming from. I would imagine at $5 an M, everyone's basically opening the taps. But it's interesting to see that. The other thing we saw here in the last month or so is U.S. LNG exports are up about 1.5 BCF a day. That's almost 18 BCF a day. And so we're seeing not only a supply response, but we're also seeing a demand response for natural gas. So, with that, Maynard, that's kind of what we've seen in here over the last last week or so. And so we'll hand it back to you.
All right, awesome. Well, Jeff, before we jump in with Kruti, anything on your mind on the markets or the world? Or
just listening to Mike, and I know we'll get into the discussion today on some of the near term. I was kind of, as we had a little break last week, just thinking about, what are a handful of themes I'm wondering about as we go through the next couple of quarters. And one, in the traditional energy space, the thing that's most interesting to me is just the anticipatory nature of specifically oilfield services stocks. So you have last quarter, oil's down almost double digit. The OIH is up 15%. And so people are like, is this a little trade that's going to pop or whatnot? But it's just fascinating because stocks are always anticipatory. Historically, the oilfield services sector, the vast majority of the upside is achieved before earnings ever bottom. So is the stock's telling us something, or is this surplus going to be a head fake? So that's probably the most interesting thing I've been thinking about in the traditional energy world. In power, this has been such a rocket ship year for a number of the new technologies, the SMR companies, et cetera. And it feels like 2026, there's going to be a sorting out of those technologies that, have real staying power versus some that kind of flounder. And the third thing that strikes me as interesting is also in the power world where, in the existing, power providers, it feels like we have a healthy kind of cross current of demand growth pool, big CapEx opportunities. There's a lot of inflation going on in there, and how do investors react to significant CapEx as it comes to fruition and projects have to be executed? And then rate pressure for the customers. How does that whole soup play out? And you're seeing there's a lot of precedent around electricity price increases, but that's kind of the whole soup I think about for the existing power producers.
Awesome. Well, Kruti, there you have it. There's always a lot going on in the world, particularly a lot going on in the world with numbers and the economy and the macro. And next week is the Fed and so on and so forth. So thank you for joining just in time to help us sort out some of these things.
I'm going to try.
Well, maybe, Kruti, we can start anywhere you want. I think we came up with, when we talked last week, thank you for making some time, but we talked a little bit about interest rates, the dollar, inflation, tariffs, energy prices, be they power or oil and gas. And also you're from India originally, so we talked a little bit about sort of a global perspective and maybe an Indian perspective. There's lots of things to discuss. How about here? Let's start here. If we were saying, Dr. Kruti, what do you think of the current health of the economy? Because I would say that's definitely a debate, right? Some people are saying slowing, prices are up, confusion. And I think maybe the other side of it is investment is up, the market is up, interest rates may be easing. Like if you were talking about the health of this economy and looking at some of the data, what would you say?
I would say that we've had the last 5 years have been a roller coaster for a variety of reasons, not just with the advent of AI becoming such a big deal, but all the related investments that go into it on the one hand. And on the other hand, we've also seen, like never before, a whole political and news-driven narrative across the world, which thrives on creating panic. Or it's basically like everything has to be a hook. You can't just say anything anymore. It has to be a hook. If it is not a hook, people will not pay attention.
Mm.
What we forget when that happens is that then we start creating hooks, whether they are true or not. So when people are all freaking out about the economy, I want to say, take a trip down the last 25 years. Take a trip down the last 50 years. We are not in any unique situation as a world that we've not been in before. The only difference is that now you have every expert tweeting about it, writing about it, and opining about it. So, yes, there are fluctuations. That's how the market works. That's how expectations build. That's how businesses react. That's how customers react. That's how employees and employers behave with each other. Yes, we've seen a lot of changes. Yes, we had a pandemic. But more importantly, we have lost sight of the fact that we are living in the long term. I'm going to quote one of my favorite economists, Joan Robinson. So I don't know if you know this, but Keynes, the big architect of the new economic style of thinking with a heavy government intervention, always said, well, in the long run, we are all dead. So we should only worry about the short run. And his own student, Joan Robinson, has done a series of articles. This is back in the 30s and 40s. And she says, yes, in the long run, we are all dead, but not all at once. You cannot ignore the long run because you're so focused on the short run. Yes, does it matter that we are looking at the next month, 10 days, actually a week for the interest rates, and then, first quarter, second quarter. But what we also need to do is to look at the past quarter, past 2 quarters, past year. Everybody's freaking out about Bitcoin. At last year, same time, it was at 86,000 and it made news. So this expectation that everything has to exponentially rise is foolish, to say it in the kindest way possible.
Can I ask you, since we're on the long run, and it's not on our short list of topics, I'm already violating the terms of engagement, the deficit, the debt, and I don't know what Keynes said about national debt, but I'm guessing he wasn't too worried about it. What do you think about the long run, the debt, the state of our national finances, and how we should be thinking about that?
Let me first start by saying that one of the reasons why the debt has exponentialized to the extent it has in the last few years is because of, and this is going to sound like I'm targeting the Fed. I'm not. I'm simply saying that there were some very irresponsible decisions made in raising the interest rates in a claim to combat inflation, but actually has made the debt worse. Also add to it the amount of government expenditure programs that have been added on because it looks good for the GDP. And again, this is nonpartisan. Both parties are guilty of doing this. So this is not me saying X versus Y. This is me saying we've given too much power to them. The debt has gone up because of that. But one of the easiest ways to start reducing it, or at least managing it, would be to lower the interest rates. Fed is a private entity. They need to lower the interest rate. And on the other hand, cut back on the government expenditures that have remained unreined for years. I mean, if we look at 20 years ago, we didn't have so much debt, we didn't have so many expenditures. I mean, right now, sorry to kind of go in a slightly opposite direction. We were talking about inflation earlier. When you start looking at what comprises inflation, you will see that one of the fastest rising costs, month after month after month, is the healthcare costs. Who is protecting these people? Because in a purely free market economy, if somebody provides you bad service, you would be able to switch your provider. Why is that not an option to the same extent in healthcare? Who is allowing them to be an oligopoly, a small group of people that offer the service, versus a genuinely free market situation where you can go buy soda from whoever you like. You don't like Coca-Cola, go drink Pepsi. Nobody's stopping you. But if Coca-Cola and Pepsi were the only two soda makers, now suddenly as a consumer, you have a problem.
Well, we guess we could add in the government reimburses you for your purchase of one of those two and make it really fun.
Oh, God.
So maybe the Fed is meeting next week. Maybe two questions for you. It seems like you brought up our focus on short-termism that has really crept into things. It seems like the other thing we've noticed, and we talk about, it happens in energy, it happens in all sorts of areas, is the way political thinking has injected itself into lots of decision-making situations. And the other one is the controversy or the manipulation or the lack of intellectually honest data, however you would describe the situation with our data. But maybe those two things have come together in a bit of a storm where someone with an agenda, creates data that supports the agenda. It's a long way of asking you, your background is all about decision-making with good data and the thoughtful use of data and the thoughtful analysis of data. Next week, what would you be thinking about if you were at the table and you were making a case for, here's what I think the data says, here's what I think we should do regardless of the political considerations?
I think that the data right now, okay, so since you brought up next week, I'm going to contextualize it in with respect to the interest rates.
Okay.
But it can apply to pretty much anything. I would sit at the table and I would look at what we have had happen objectively in terms of the tariffs, in terms of the political upheaval, and other considerations that are taking up so much of the energy in our economy right now. And those are a lot of social things. I'm not saying they're not important, but they should not factor into a decision-making process. I am just using this as an example, of course, Maynard. I may not like you, but that does not mean that I should not respect what you have to say. And I think that's what a lot of us have forgotten, that we are confusing our feelings and our emotions and allowing those to make decisions on what we support and don't support, instead of allowing the data to tell us what we need to know. And like I mentioned earlier, and like you mentioned earlier, when the data is being presented with an angle at every point, it is even more critical for people like us to take a step back and say, let me look at the trend. If you can't look at a trend yourself, dude, just pull the data out and throw it into any Copilot, GPT, whatever you use. At least see the trend. I'm not saying ask it to analyze it, because that's not going to be biased, but you can definitely ask it to create a trend line so that you can see what's happening. And when you see what is happening, make your own judgment. When the best way to break out of short-term thinking is to actually see the long-term view. And so it applies to, like interest rates should have been cut. I've said this again and again since March. By now, we should have been down to maybe 3%, right? I'm not going to the extreme of, oh, cut it by 2%. It doesn't work that way. It can create a disaster in the market. But a quarter at a time, because you know what? It took them 2 years to take it from less than 2 to 4.5%. So it should not take more than 2 years to bring it back down to 2%.
Well, so let's pick up on these points. So interest rates, when you pull back and look at the data and think about what costs are going up, what employment's doing, all the things you look at, I'm no expert, but what would be the key data points if, because I know you said you would have been bringing it down since March and we'd be at 3% right now. But what are the key data points if the Fed was listening today, that you'd say, these are the points you should really focus in on, or here's the long-term trend?
I would say that they are worried about an unemployment rate that has been hovering around the natural rate of unemployment since 2021. The 4% freak out that people are going in for, that's our natural rate of unemployment in the United States. It always has been. It's just that it wasn't on social media until, recently. So that's a valid concern. Inflation is a valid concern, but what is getting inflated is the key thing. A lot of the inflation is also being driven by labor prices going up. So I'm going to kind of go into a little bit of economics. Bear with me, all right? There's aggregate demand and aggregate supply in any, in any given economy. The aggregate demand represents the goods and services that are purchased by people. I'm oversimplifying it. And it depends on the liquidity, money, and the investment and savings curve. So these are the 4 things that contribute to aggregate demand in an economy: investments and savings, and liquidity, and the money, which determines the interest rate, right? The aggregate supply, on the other hand, is exclusively determined by the resources in an economy. That's land, labor, capital, and entrepreneurs. They determine what the aggregate supply is going to be based on their productivity, right? So if you think about it, these 2 curves, in the long run, how much can all the resources in a country create is a steady vertical line. So the long run aggregate supply curve is always a straight line. In the short run, however, because it fluctuates with price levels, you're going to see it upward sloping, like you're used to seeing a traditional supply curve. So it always goes from bottom to top, right? And then the demand is going to go down, demand down in the opposite direction. That's what creates the equilibrium. When liquidity money, which is managed by the Fed or monetary policy decisions, and IS curve, which is managed mostly by fiscal policy and government policy, are fighting with each other, that aggregate demand curve swings instead of staying steady. And when it swings, we lose that equilibrium point. We have lost that equilibrium point. And the panic that we are seeing is because of the short-run response of the aggregate supply curve. However, in the long run, the capacity can only go up if our productivity increases. So the technology that we are seeing right now kind of goes back to what Jeff said earlier on. We are seeing some major capital gains on the one hand, and then on the other hand, we are seeing these layoffs and employment situations which are concerning. They're all short run. And one of the things that we need to do, this is the data I would put in there. look at the long run behavior of employment rates, unemployment rates, GDP growth rates, which is what is determined by the equilibrium of aggregate demand and supply, and the price levels. Again, that's the inflation. And how it has fluctuated with the rate of interest changes point after point, month after month. These are the data points that and these are all publicly available data. Just go and find the data, drop it into your favorite AI or Copilot or whatever, see the trend, and then decide if our current location on that trend is worth worrying about as much as we are, or are we just going through a major growth phase? We are like back in the 20s when cars started becoming popular, you had the drivers who were driving the horse carriages. And their livelihood was entirely being challenged and changed because these cars were taking over. We are like those horse carriage drivers right now. Things are changing fast. And if we don't learn to drop our reins and learn how to drive a car, we're going to be left behind.
So does that mean, Kruti, if you were thinking about this, and you're the Fed, the case to lower interest rates is the disruption in employment, the disruption in, kind of the examples you're citing, the restructuring of the economy that's going on. And then the other reason to lower interest rates is GDP, and GDP is tepid, its growth is tepid. And then your other comment I think you're making, I'm trying to speak Kruti here, is that if you're keeping rates high to fight inflation, inflation is being caused by government spending. And so you are applying a weapon to a problem that it doesn't fight, because ironically, when you keep rates high, you're just increasing the cost of the debt, and that's driving up. That's more spending. I guess the one question I had of that is, if part of the problem here is the government, if you lower interest rates and try to address employment and GDP growth and the state of the world, doesn't the government just find more ways to spend? Like, what do you do about the fiscal situation, or is that just not the Fed's purview?
So I'm going to go into some economic theory without getting too complex about it. But for a developed country, I know it sounds outdated to say developed and underdeveloped, but bear with me.
I never know if that's politically correct anymore, if you're
I don't
allowed
care
to say
about
that.
political correctness, otherwise we probably wouldn't be talking, right? But in developed countries, when the GDP growth rate goes much higher than 2%, it means that there was something happening where the resources were not being productively used to start with. So, as a developed country, if you want a GDP of higher than 2% growth rate, GDP growth rate of higher than 2%, something drastic needs to change. Because otherwise, the high growth rates that we are talking about, that we see in places like China, India, etc., that's because they are developing countries. Their resources are not already being used to the maximum capacity. So if we are running after 2, 3, 4% growth rates in GDP, and we are making it happen by shoving government spending in there, then we are doing ourselves a disservice, because we are now sliding down to the level of a developing country, which automatically means that our labor is not at its full capacity. It's a catch-22. And here's the graph that I was trying to draw. The IS curve that you see here, this is the LM curve. That's what the Fed controls. right? And then this IS curve is what fiscal policy controls. When they meet, that is the rate of interest that exists naturally in the market. However, when the Fed decides to move this LM curve to a higher interest rate, right? So if you think about it, this new line that I drew, if that is where the interest rate is going to be, look what happens to the output. It's going to fall. And when that output falls, right, we're going to see a shrinkage in our GDP. So GDP growth is not tepid, it is actually negative, and it is being compensated and offset by government spending, which is very unhealthy for the economy in the long run.
Let's talk about tariffs. We'll just jump ahead to tariffs and bring it into this discussion, because if you listen to, you made the comment, we should have started cutting in March. We should be down to 3%. And, you know, as I replay the tape and think about the news stories and the discussion, the tariffs and what tariffs would do to inflation and the uncertainty around tariffs was a significant reason for going slower on cutting rates. So maybe help us think about that as a variable. And then while you're at it, the other thing that's fascinating about tariffs, just watching it from the cheap seats, is it does seem to be raising a lot of money for the federal government. And so it's now this source of income. It was a source of, it was a reason for waiting. But maybe just talk about tariffs, and Mike's and Jeff are going to jump in here, but that weave that one into this interest rate discussion for us.
You're going to love it. Here we go.
Okay.
See the red line?
Yes.
Okay, so that's what happens when the tariffs are increased, because it increases the cost of manufacturing in a country like ours, where we are heavily dependent on imports for certain critical goods.
Okay.
So you see how it switched up? The red line, and see what it did to the interest rate?
Yep.
So now we are at a higher interest rate in real world than what the Fed is claiming it is doing. So if the Fed interest rates were lower, then we would probably naturally have been already at this at the same interest rate in terms of the addition to whatever the Fed's charging. Right?
So did you just say, and let me just try this. Sorry, Mike. Tariffs are a tax. They're tax on somebody, or they are a increase in cost. And the Fed's reaction could have been, we need to alleviate that burden on the economy by cutting rates, instead of saying we should consider keeping rates where they are to fight the inflation caused by those tariff costs. Is that what you are basically saying?
I know, but I don't agree with tariffs are a tax. And here's why.
Okay.
Tax is collected from the people who live within the country. Tariffs, on the other hand, are collected from people who are importing from another country. As a producer or seller or intermediate seller of any goods, tariffs allow the choice of finding alternatives. It's kind of like this. When you go to purchase something from the store, you are making the choice to purchase it, regardless of its price. Nobody's forcing you to it. Tax, on the other hand, you don't have a choice. It's like taxes and death, right?
Yeah.
So it is not a tax in the traditional sense of the term, and it does not necessarily go back to the people who pay it.
So I suppose if we had a tariff defender on the show, the tariff defender would say, hold on, the entity that's going to pay that tariff is either the importer or the exporter, like they'll find a way to divide up that cost. And then it's going to trickle through to the economy based on whether or not the consumer decides to continue to, the consumer still has a choice. So whether the impact of the inflation depends on their selection.
Absolutely. And here's the proof of it. Remember how cars and the tariffs on steel were like the biggest fears? And I'm not a tariff defender. Let's start by saying, getting that, this is just objectively.
Well, you won't be invited to any parties if you say you're a tariff defender.
I'm already not invited to parties, evidently. But jokes aside, because of the way so the market has already proven this consumer-driven behavior if you look at it closely. So I don't know if you've been following the news this last week. They had a record sales on Black Friday and all of that, right? But then when they split up the data, they found that Gen Z actually has cut back in terms of the generational spending. They're cutting back tremendously on spending. All of a sudden, handmade items and personalized gifts are being given a higher priority. Despite all the things with the cars, everybody expected prices are going to go up through the roof. They have. But you know how consumers have responded? They're not buying new cars. There's a reason why the used car market has blown up. It's because if the producers refuse to bear the costs or make choices of sourcing their resources from the right places with lower tariffs, consumers are basically indicating, nah, dude, you chose to import this. We don't have to buy it.
Kruti, I wanted to go back to one of the points you made earlier. You talked about healthcare costs going up quite substantially. And when I think about inflation, I think about healthcare costs. I think about government spending. I think about housing costs, labor costs, but I also think about energy. And you hear Trump out there every day talking about how oil prices are low, gas prices are low, yada, yada. And that's true. And you're seeing that in inflation numbers. But if you look at where our society is going, we're going more electrification, right? And if you look at the inflation numbers from an electrification standpoint, they're going up. It's a smaller piece, but they're going up quite substantially. And we've kind of labeled the inflation that we're seeing as, we think we should look at price at the plug rather than price at the pump. Do you agree with that? Is that something we got to keep our eye on? Because we are changing. It's sort of like an industrial revolution going on right now, and how we make things, how we consume things. What are your thoughts there?
I absolutely agree with you. And actually, earlier on when we were talking, when you were reading out the data, that point came into my mind, and I'm glad you brought it back up, because it is the fact that there is a higher dependence on electric vehicles now. There's a reason why natural gas is suddenly going up. And that reason is that the electricity usage is no longer being used maybe for manufacturing and households as much as for charging cars. And I mean, okay, do you remember the Christmas movie, where the dad is plugging in like 12 things into one socket? Like, that was all of us until not that long ago. And now I don't know anybody who does not have a multi-plug charging thing, because they have so many devices. So electricity and the use of electricity has evolved. And so the traditional methods of measuring, like what we call the basket of goods for the inflation, I think that hasn't kept up. When we are still measuring inflation based on the numbers as the base year from 1981, we are doing everybody a huge disservice, because none of us has a traditional phone anymore. None of us has traditional cable anymore. And you know what? You don't want to watch your TV? That's fine. Your TV is still going to be on, and it's going to be playing music for you. This is this kind of stuff that my mother would have, not physically, but verbally beat out of us, right? Why is this light switch on? I don't hear anybody asking that question anymore, because everything is always on. So yes, there is a difference in the way we are consuming energy. And the prices are fluctuating, especially for gas. not natural gas, but like oil, right? Because we still have the dollar pegged to it. Every time the damn dollar shifts, the price of that shifts. And because we are such geniuses, we are counting all of that in the inflation numbers, which means we are not telling the truth about what people are paying out of pocket. We're not telling the truth about what does it mean for pay to plug instead of pay to full, you know? So I don't know if that helps, but yes, we are on the same page.
And Kruti, I'd like to go back to where you restarted all the short-termism, and I like the idea of kind of taking a step back. And you mentioned long run. What are if you were to have three issues over the long run that pique your interest the most? Sounds like one of them may be just the government and fiscal policy, and is there ever going to be constraint? But what would be that top three list of kind of long run critical issues you have your mind focused on?
Okay, one of them is the production function of any given economy. And that is basically, just to simplify it, how the resources are used in combination with each other. So land, labor, capital, entrepreneurship, and technology, because the technology can enhance all the others. How are they being used to increase our production possibilities curve? So that, because that determines the long-term aggregate supply. That's issue number one, I think, for me, interest-wise. The second thing is, a lot of people think that technology is a replacement for human beings. And when I see the trends within the labor market, I don't really focus so much on the low-skilled workers, but the high-skilled workers. And the reason I do that, and this is going to sound like I'm going off on a separate track, but I really am not. It's because the quality of our higher education has deteriorated. It's become a marketplace. And when we see that happening, I come from a country where public education, higher education has always been free. There's a reason why I chose to do my Ph.D. in the United States and not in India. And that's because there is a qualitative difference when everything is in a marketplace, whether it's publicly funded or privately funded. And I think that's where we are headed. That worries me. And that immediately and directly impacts the local quality of local labor. So that's my issue number two. And issue number three, inflation doesn't bother me. It's just, it fluctuates. But more than the fiscal policy, I mean, yes, the government spending, but more than the fiscal policy, it bothers me when I see that the monetary policy is trying to drive the economy, because that is more rigid and more difficult to adjust unless every member of that federal committee is engaged in ensuring that the local economy gets the boost it deserves.
So I think if I was following that right, Kruti, is if you're at the table next week, unlike how I characterized it in the beginning, you'd be, I think, really saying more, we're supposed to fight inflation. We have some outdated ways that we think about how to calculate that. So let's really get into the data that is most telling when it comes to inflation. And as you've looked at that data, you think that data suggests we should cut rates?
Absolutely.
So what would be, hey, give me 46 minutes. I'll eventually figure out what you said. But so seriously though, because I was pulling up, just on ChatGPT while we're talking, the components of CPI, and it does look like something right out of the 50s. I mean, it's like, what does apparel cost? What does transportation cost? It looks very basic. It's probably been a while since we thought about how to measure inflation. But if you were trying to pick one or two or three things to just test what is the level of inflation, what would you pick? How would you determine it? Or if we said magic wand, recalculate CPI with a new formula, how would you think about that?
Well, first, let me say that would be my dream come true.
Wow, we're there. The 47-minute mark, we hit Kruti's dream.
I would love to be one of the people who works on recalculating the CPI.
Wow. By the powers vested in COBT, we now make this possible.
So that being said, that should tell you also that I have investigated it way more than I should have. But I always get thrown by certain breakdowns that they put in there. So you have the main categories, you have the food, you have the energy, healthcare, and transportation, where they look at automotives and other stuff. And then there's a whole other group, right? And lots of subcategories in all of this. The irony is they already have the data they need to do this right. They're just not calculating it correctly. They're not weighing it correctly. And the reason I say that is because we are talking about the consumer price index. We also have a producer's price index, by the way, which is separate. So when we are looking at consumer price index, we should not only be considering gas prices or oil prices from a wholesale perspective. You have to look at them from the individual spending perspective. That's not being done. It's the same way with healthcare. What is the average person paying for healthcare is given less weight than what is the total expenditure on healthcare. So if Medicare is left, right, and center, encouraging everybody on Medicare to go and get whatever surgery they waited their whole lives for, because now it's free, it's still showing up on my inflation, still showing up on what I pay to the insurance company, but not to the same extent. So it is misguiding. It's misleading.
So does that mean that if you were calculating inflation, you would go to the consumer level and create and look at a sample of representative people and see how their costs were changing?
I would first and foremost change the basket of goods that we are taking into account anymore. Our needs versus wants need to be cleared out significantly more than they were in the 80s. And I know that they've updated some of them, some of their categories. But clothing, really? Clothing is still in there? How many people need to go and buy clothes all day long? Like, how are you comparing buying clothing with cars in one place? Why? Because it should be on a per unit basis over a fixed period of time. In today's day and age, at least that's true.
Is there some economist that would argue with you, kind of like the, sports stats or something like this, which is like, yes, I know it's flawed, but it's consistent over time, and it's important that we, measure things. Let's don't tweak it. Like, yeah, you're right, Kruti, but we got to keep this apples to apples. Is this an argument in this area?
You guys work in the energy sector, so I'm just going to ask a counter question before I answer that one.
Uh-oh, get ready, Mike, Jeff.
How many businesses do you know who have told you we've always done it this way?
A lot.
And it doesn't make it right, does it?
Yeah.
So I agree. And actually, I think every economist out there who's into the macroeconomy study would say that it would completely destroy the consistency, etc., over time. But other countries have done it. India changed its basket and inflation calculations not that long ago. And one of the ways that they did it is you maintain the current measure as you transition into the new measure. Our own Fed has done it in the past 20 years. It wouldn't be the first time that adjustments are being made. But I think adjustments need to be made at a micro level as well as the macro level. Continue. This is a set method. I get it. Continue measuring it out. Switch to the new method. Eventually, you get to a point where you've collected enough data where the new method the other one can be phased out. It doesn't have to be overnight. Again, long run, short run.
Really interesting. Well, Kruti, the time with you has gone by faster than maybe any guest in history. But maybe with the time we have left, you just mentioned India changed its how it calculates inflation. We've touched on tariffs. We kind of touched on energy prices, but India was something we wanted to talk a little bit about with you because it is one of the key rising economic powers on the planet, and we're always curious to learn more. What would you share with us about maybe what people don't understand about India, its growth, its future, how it governs itself, why it's a good place to do business? Tell us a little bit more from your perspective.
It's going to sound completely biased, but I'm going to go for it anyway. India is one of the few foreign countries where English is one of their official languages. In fact, even within India, people are most comfortable communicating with each other using English because even though we have a national language, not all the states use it. Everybody has their own language. So unlike the United States, where all states speak English, American English, sure, but India doesn't have that. So English is the common language. So when it comes to being able to communicate with the people there, it's a lot easier. Yes, I have heard this. I'm guilty of making fun of it myself. Accents are an issue. Just because somebody speaks with an accent doesn't mean they think with an accent. So we can move past that in today's day and age much better. That being said, and this is true also of China, what I'm about to say, these economies, India, China, as cultures, are a savings-based culture. The per capita gold, for instance, that that families have in these countries is higher than a lot of us here. The reason is the culture itself is savings-based. And if you kind of go back to what we were discussing earlier, savings are an important part of aggregate demand. So one of the reasons why these countries are growing and are growing rapidly is because with advancing technology, they are able to shift their production possibilities curve at a rate which is much faster than a lot of other countries. So there's a focus on move that aggregate supply curve, move that production possibilities curve, and kind of start maximizing their own resource usage. So as partners, a lot of these developing countries could actually be what we are looking for, because that's the beauty of trade, that you can do what you're good at, let them do what they're good at, and you trade so that both teams get the best of all worlds.
It's hard to squeeze India into the last 8 minutes, but Mike, anything on your mind?
Yeah, I think one of the questions I have, I think it's a sort of a big picture question, but there's this concern in just the U.S. and just globally that AI, robots, stuff of that nature is just going to lead to just a massive jump in labor. Just labor is just going to plunge. What does that mean for society? And I kind of look at what you said about the buggy whips and the automobiles. I mean, if you look at that, the market expanded by 100-fold, right? And when I think about this right now, it seems like there's a lot of concern that, yeah, people are going to be unemployed. But when you think about the potential productivity gain in the U.S. society, the pie might be massively bigger, which provides more opportunity. How do you think about that? I mean, are people getting too concerned with this? I mean, are you concerned? How do you see this playing out?
I actually think that the fears are far worse than the reality. So here's a little anecdote that will probably help you understand where my mind is going. When airlines first started flying airplanes, there's a reason why you have those puke bags in the seats. And the reason is that we often react as human beings when we are in unfamiliar territory. We have unexpected reactions. Those puke bags started becoming so common in airlines because people would be like, oh my God, I'm flying. Well, right? Over time, that has gone away. Similarly, and I've seen this firsthand, a lot more people, when I was growing up, India was still a fully socialist country. This was in the 80s. And and it was very common whenever we went, because we didn't own a car or anything. Nobody we knew owned a car. We didn't even have a telephone. And when we went somewhere, and if we took a car instead of going by bus or train, I remember my mom always having a bag because she would throw up the whole way through, and it would take her 2 hours to recover. It's no longer a problem, but it was psychological. It's the fear of not having done something. And I've seen that in multiple people. Like I said, with flying, with my mom's going to kill me for saying that. Anyway, but the point is, we are in that situation with AI right now. We are in unfamiliar territory. We are terrifying ourselves about the possibilities because we also live in a world where hooks are so attractive. Oh my God, the AI is going to turn into a human being and come kill you. Now suddenly you're paying attention, even if I just completely fabricated that. But we live in a world like that right now. So you have to remember, these are just puke bags. We won't need them later.
So back to the question of, do you think the overall economy gets massively bigger and really kind of, we don't have to worry about the debt because productivity is going to be so much more, GDP is going to be so much more. So we're going to have the flexibility to do a lot more things to contain that debt. Is that kind of how you think about it?
I would like to think about it. The problem is that we have no control over certain decision makers who also impact the other side. Because you could have aggregate supply that goes up to infinity. But if the aggregate demand is being held in check, who's going to buy those goods?
Well, it's kind of in the same vein. If the Fed and focus on short-term interest rates gets so much airtime, but if we have no confidence that fiscal policy is controlled, why would anyone buy long-term debt? Like what's the it seems like there's no there's no governor on that. So it's to me that's the most fearful thing that I have in the economy is we have what's the impetus to buy 30-year debt in a government that has no fiscal restraint?
I cannot speak on behalf of others, but I've always felt that the 30-year, 50-year debt cycle is one of the biggest detriments that Gen X has faced and Gen Z is currently facing. You should not buy a house if you can't afford a house, period. If you have to take a 30-year loan for it, maybe you should buy a smaller house and pay it off in 5. I know it sounds exactly opposite to the consumerism that we are used to being fed. This is exactly why our inflation and related fears are going up. It's like we are so addicted to purchasing that we can't break out of that cycle. And we are so used to just being like, I'll just put it on my credit card. 30%. I have almost a perfect credit score, and my official interest rate on my credit card is 29%. Never used it because I use it for the points and then pay it off every month. But the point is, 30% with an almost perfect credit score. What does that mean for the people whose credit scores may not be perfect, who might have had a situation which required them to go get debt? How much are they paying? And where is the consciousness about this? We're constantly fighting about, oh my God, he said this and she said this. But where is the financial literacy? Where are the tools?
As we wrap up, this has been so interesting. I was wondering if you could touch on one last thought, which is because so many of your comments have gone to, the economy's a frontier, like how much can it produce? And it seems like both sides of the aisle they've both leaned in more to manipulating the economy generally. And do you have any observations about if we were in the war room of the White House or Washington or something, if we're really trying to liberate the economy, we really want to grow, we really want to create more wealth, we want it to improve the capacity of the economy, are there one or two things that would be your favorite suggestions for, boy, let's pull that regulation, or let's push that supply, or let's improve that feature? Are there a couple of things that you think about that we really ought to be doing as a society to improve our economy?
It's going to sound partisan, even though it's not, okay? But heads up. I was really hopeful about what Doge had set out to do. Of course, those hopes were shattered very quickly, but that's what we need. We need to make the government leaner. The fact that we were able to survive 40 plus days, almost 40 days, of government shutdown with only essential services being in play tells you everything we need to know about how much waste is up there. So if I had another magic wand, that's what I would do.
All right, that's good. That makes it two magic wands. We're changing the definition of CPI. We're updating it. We're going to keep calculating the old stat, and we're bringing back Doge. I think that's what
I don't know about Doge specifically after I saw some of the stuff they did, but
we're bringing back the spirit of Doge.
Yes, the spirit of Doge. There we go.
The spirit of Doge. Well, Dr. Lehenbauer, we really appreciate it. You're over. I didn't say you're in San Antonio, so you're not far from us. You'll have to come see us in Houston. We'll come see you. But this is for those of you listening or watching. Kruti does a lot of things on LinkedIn, a lot of videos, a lot of cool. You saw her Post-it note today. She does a lot of things where you take a topic and reduce it to a Post-it note. So we encourage everyone to keep up with her and reach out as you have questions or comments.
Absolutely. Always happy to answer questions and talk.
Well, we enjoyed it. Let's see what happens next week. Even though that's a little short-termism in thinking, let's see what happens over a multi-decade run. Thank you so much, Kruti.
Thank you. I'll see you guys later.
Thanks, everybody.